Hey, what's going on, everybody? Welcome back to Bonafide Investing, where we talk all things high yield investing, options, futures, and just investment goals in general. If you're new to the channel, welcome. I want to give you a little bit of background about what we're doing here. This cash flow life portfolio, I took a big chunk of my net worth, about a quarter of it roughly, and I put it into what I'm currently calling a $500,000 experiment using my own capital as well as margin. And the goal of this strategy is to pay my bills while also maintaining and paying down my margin over time, as well as controlling for risk and inflation moving forward. So one of two things will happen. It will succeed. I'll keep adding money to it, or it will fail and I'll go back to the drawing board and try something new. So hit like and subscribe if you like what we're doing here. Love the support for the channel. Please know nothing here is investment advice, not now, not ever. So please do your own due diligence before making your own investment decisions. What I want to do today, the main focus is just kind of give a portfolio update, some changes I made today, and just kind of dive in there. So what we're doing currently, I bought another SPY put as well as QQQ put, 2 leaps expiring at the end of 2027, just buying 2 years of protection for the portfolio. I've talked about it in past videos. I'm a firm believer that this market is well overheated, and I think FOMO is going to be coming back into the market. And I think that the next couple of years are going to look very different than the last few years did. So just want to have the hedge. I always say need over greed, control for risk before worrying about your return, right? Both are important, but if you lose everything, right, and then you become insolvent, you have nothing left to live off of. So bought a couple puts. My speculation play for 2026 is USO. I think oil is the commodity that has not really participated with a lot of other commodities. I think energy will have a good 2026. That's my opinion only. We'll see how it goes, right? I think gold, silver, platinum have just had monster 2025s. I mean, they're having a monster day today, just absolutely going ballistic. So I bought a call on USO, the $65 call expiring in about 13 months. Reason I did it, I looked at selling the puts. The premiums really weren't worth it, and I'm risking far less in capital. I believe the USO, let's see here, the USO cost me $1,275, right? So that's all I could potentially lose. So liked that a lot better. I feel like I'm not putting up too much money on this investment. We'll see how it goes, right? So oil is my speculative commodity. I think we'll have a good 2026. If I'm wrong, I'm wrong, but I kind of like that it's just been beaten down, ignored. So feels very contrarian at this point in time. Sold a put on Nike, sold a put on Chipotle. So don't mind owning these 2 stocks at lower prices if they continue to fall this week. If I am put any of these shares, I'll turn around and sell a call next week on them. Just want to generate a little bit of income off the puts. So give a little update here on the stats for the portfolio. It's currently sitting at about $380,000 plus the margin of about $134,000. We're just north of $500,000 total. I am dollar cost averaging back into my strategy each and every market day across bonds, cash, equities, gold, as well as real estate. And you can see these recurring buys as I scroll down here. WPay, I have to manually buy $30 per day because that is a 15% allocation target because Robinhood will currently not let me set that on autopilot. So only thing really down today is nothing's really down. I mean, the long bond was about flat to a little bit of down. Rates went up a little bit earlier in the day today. They've since recovered. But yeah, I just want to hedge, right? Today's another up day for markets. The higher these things go, the more I want to hedge this portfolio. What's really nice about the QQQ and the SPY is that, volatility is currently low. Like I said, the VIX is right around 13, 14. So on the lower side, which means insurance to buy puts right now is lower, right? Typically they move inversely to each other. So I can control now, 600 shares between QQQ and SPY, 300 shares of SPY, 300 shares of QQQ. I'm not locked into these, right? I can always roll them later, right? If the market collapse that I'm anticipating coming soon doesn't ever materialize, fine, right? I'll have reinvested about $100,000 back into this strategy via dollar cost averaging, plus any money I bring over, right? And it will continue to pay my bills. So again, the puts on the Qs and SPY are just catastrophe insurance. That's why I buy them about 20% out of the money. That way I can save on premium, and I don't mind the 10 or 20% sell-off corrections. They're healthy for markets. They are necessary. And I'll just be dollar cost averaging back into lower prices, hedging that risk even more. So that's where my risk mitigation comes into play. The puts, as well as the dollar cost averaging. Next month, I'm probably going to add another downside hedge, an inverse ETF that we've talked about before. So we'll see how that goes when I bring over $100,000 next month. So margin buffer went down a little bit, down below 60%. I'm fine with it. Again, I like to keep it above 50%. Reason for it is I bought the 2 puts in the call, and then I have my options collateral of about 9,400 as I sold puts on Nike and Chipotle. So just a little update there. Wanted to talk about the portfolio. Really want to talk about gold and silver on the next video and what I think they are trying to tell us in this market. Maybe talk about the bond market in a future video as well. But again, I think there is a lot of froth and a lot of, I don't know, maybe FOMO's coming back in. But these levels, there really isn't much value left, right? I mean, the Qs and the SPY, the NASDAQ and S&P 500 respectively, they're starting to look very similar. So market concentration is really high right now. Relying on 7 to 10 stocks to really carry the market is very risky. I think 2026 will be very tumultuous. I think there'll be a lot of volatility, which could be open up a lot of opportunity for options, right? Usually when volatility goes up, premiums go up as well. So we'll look at that as we go. But again, having the hedges, having a little cash in there, having some long bonds, which historically have done well in deflationary times. But yeah, I think we could see more inflation in our cost of living, but that doesn't necessarily mean we'll see more inflation in the markets, right? So, and that's the worst case scenario. Your cost of living goes up, but your assets go down. But it's happened, and it's happened before, and I think it will happen again. Not to be a broken record, but I think we're going into a different cycle where we're going to see higher inflation. We're going to see higher interest rates. And ultimately, I think we potentially could see a lost decade in equities. So we'll talk more about that. We'll kind of roll with the punches as things develop. Again, nobody has a crystal ball. Nobody can see the future. These are my opinions only. But at the end of the day, I like to sleep well at night, right? So I don't mind paying roughly, I've paid about $15,000 so far for portfolio insurance. And currently my portfolio is paying me about $30,000 more than what my bills are. So I don't mind using some of that to hedge this to the downside. So anyways, we'll talk, I'm going to make another video on gold and silver. We'll talk about precious metals and the importance, and I think what it's trying to tell us in a video coming up here this week. And hope you got something for this video today. Have a great day.